Investing might sound complicated, but it's really just about putting your money to work. It's a way to make your money grow over time, rather than just sitting in a bank account or under your mattress. Instead of letting your cash sit idle, you can invest it with the hope of it growing over time. This means putting your money into different types of assets that have the potential to increase in value. Think of it like planting a seed. You start with something small, and with the right conditions it can grow into something much larger. You put it in the ground, invest your money, and with time and care, smart investment choices, it can grow into something much larger, a bigger sum of money. Just like a plant needs water and sunlight, your investments need attention and the right strategy to thrive. There are many different ways to invest, and each comes with its own set of risks and potential rewards. Stocks, bonds, real estate, and mutual funds are just a few examples. Some investments are considered riskier but offer the potential for higher returns. For example, investing in the stock market or cryptocurrencies can be volatile, but might yield significant profits. Others are seen as safer, but might not grow your money as quickly. Government bonds and savings accounts are examples of lower-risk investments that provide more stability. The key is to find investments that align with your financial goals, risk tolerance, and investment timeline. This means understanding what you want to achieve and how much risk you're willing to take. This means figuring out how much risk you're comfortable taking, how much money you want to make, and how long you're willing to wait to reach your goals. It's about balancing your desire for growth with your need for security. Investing is an essential part of building a secure financial future. It helps you prepare for long-term goals and unexpected expenses. Whether you're saving for retirement, a down payment on a house, or your child's education, understanding the basics of investing is crucial. By learning how to invest wisely, you can make informed decisions that will help you achieve your financial goals and secure your future. Long-term investments are like planting an oak tree. You start with a small sapling, knowing that it will take years, even decades, to grow into a towering, majestic tree. You know it will take time to grow tall and strong, requiring patience, care, and the right conditions to thrive. But you're patient, and believe it will be worth the wait. Just like nurturing a tree, long-term investments need time to mature and reach their full potential. These investments are typically held for 5 years or more, often even decades. The longer you hold on to them, the more opportunity they have to grow and compound. One popular long-term investment is stocks. Stocks represent ownership in a company and can offer substantial returns over time. When you buy stock in a company, you're essentially buying a tiny piece of ownership in that company. This means you share in the company's successes and failures. If the company does well, the value of your stock can increase. Over time, this can lead to significant gains, especially if the company continues to grow and expand. Another common long-term investment is real estate. Real estate can provide both steady income and potential appreciation in value. People invest in real estate for various reasons, including generating rental income and benefiting from property value appreciation. Real estate can be a tangible asset that often increases in value over time. Retirement accounts, such as 401(k)s and IRAs, are also designed for long-term growth. These accounts offer tax advantages that can help your investments grow more efficiently. These accounts allow you to contribute pre-tax dollars, which can then be invested in various assets like stocks and bonds, growing tax-deferred until retirement. This means you won't pay taxes on the gains until you withdraw the money. Long-term investments require patience and a willingness to ride out market fluctuations. The market will have its ups and downs, but staying the course can lead to substantial rewards. They are best suited for goals that are further down the road, like retirement planning or funding a child's college education. By starting early and staying committed, you can build a solid financial foundation for the future. Short-term investments are more like planting flowers. They require less time to grow and bloom compared to long-term investments, which are more like planting trees. They might not grow as tall as trees, but they can still add beauty and color to your garden, or in this case, your investment portfolio. These investments can provide quick returns and add diversity to your financial landscape. They are investments that you plan to hold for a shorter period, typically less than 5 years, sometimes even just a few months. This makes them ideal for those who need liquidity and want to avoid the long wait associated with long-term investments. Savings accounts are about as basic as short-term investments get. They are easy to open and manage, making them a popular choice for many. They offer low returns but provide a safe place to park your money and earn a small amount of interest. The interest rates are generally lower compared to other investment options, but the safety and liquidity they offer are unmatched. Certificates of deposit, or CDs, are another type of short-term investment. They are slightly more complex than savings accounts but offer better returns. When you invest in a CD, you agree to keep your money in the account for a fixed period, typically ranging from a few months to a few years. This commitment is rewarded with higher interest rates. In exchange for this commitment, you earn a higher interest rate than you would with a traditional savings account. The longer the term of the CD, the higher the interest rate you can expect to receive. Short-term bonds are debt securities issued by governments or corporations. They are a way for these entities to raise funds for various projects and operations. They typically mature within a few years and offer regular interest payments. This makes them a reliable source of income for investors looking for steady returns. Short-term bonds are generally considered less risky than stocks, but offer lower potential returns. They are a good option for conservative investors who prioritize capital preservation over high returns. Short-term investments are a good option when you need to access your money quickly, or want to avoid the volatility of the stock market. They provide a balance between risk and return, making them suitable for various financial goals. They are well suited for saving for near-term goals, such as a down payment on a house, a new car, or a dream vacation. By choosing the right short-term investment, you can ensure that your money grows while remaining accessible when you need it. One of the main advantages of long-term investments is their potential for higher returns. Over long periods, the stock market has historically trended upwards, outperforming other asset classes like bonds and cash. This means that if you invest in stocks for the long haul, you have a good chance of earning a higher return on your investment. Another benefit of long-term investing is the power of compound interest. Compounding is like magic for your money. It's the process of earning interest on your initial investment plus any accumulated interest. The longer your money is invested, the more time it has to compound and the more significant your returns can be. Long-term investments also allow you to ride out market volatility. The stock market can be a roller coaster, with periods of both upswings and downturns. By staying invested for the long term, you can avoid making emotional decisions based on short-term market fluctuations and benefit from the market's long-term upward trajectory. Section 5. Advantages of short-term investments. Short-term investments offer their own set of advantages. Perhaps the most significant benefit is liquidity. Liquidity refers to how easily you can convert an asset into cash without affecting its price. Short-term investments are highly liquid, meaning you can access your money quickly if needed. Another advantage is lower risk. Short-term investments are generally considered less risky than long-term investments. They are less susceptible to market volatility, meaning your investment is less likely to lose value in the short term. Short-term investments offer predictability. With investments like CDs, you know exactly how much interest you'll earn and when you'll receive your money. This predictability can be helpful for budgeting and planning purposes. Because of these characteristics, short-term investments are a good option for preserving capital and ensuring that your money is available when you need it. Section 6. Disadvantages of long-term investments. While long-term investments have the potential for higher returns, they also come with certain drawbacks. The most significant downside is the higher risk involved. Long-term investments, particularly stocks, are more volatile than short-term investments. This means that the value of your investments can fluctuate significantly in the short term, and you could potentially lose money. Another disadvantage is the lack of liquidity. Long-term investments are less liquid than short-term investments. It can be challenging to sell your investments quickly without incurring losses if you need access to your money in the short term. Long-term investments require patience and discipline. It can be tempting to sell your investments during market downturns, but doing so can lock in losses and hinder your long-term returns. Successful long-term investing requires a long-term perspective and the ability to stay the course even when the market is volatile. Section 7. Disadvantages of short-term investments. While short-term investments offer liquidity and lower risk, they also have some downsides. The main disadvantage is lower returns. Short-term investments typically generate lower returns than long-term investments. This is because investors are compensated for the increased risk associated with investing for longer periods. Another drawback is limited growth potential. Short-term investments are not designed for significant capital appreciation. They are better suited for preserving capital rather than growing wealth. Short-term investments can be susceptible to inflation. Inflation is the rate at which prices for goods and services increase over time. If the return on your short-term investments is lower than the inflation rate, you could be losing purchasing power over time. Section 8. When long-term investments make sense. Long-term investments are an excellent choice for goals that are further down the road. One common example is retirement planning. Since retirement is a long-term goal, you have more time to ride out market fluctuations and benefit from the potential for higher returns offered by long-term investments. Another scenario where long-term investments make sense is funding a child's education. If your child is young, you have a longer time horizon to invest, allowing you to take on more risk and potentially earn higher returns. Long-term investments are also suitable for building generational wealth. These are assets that you pass down to your heirs, such as children or grandchildren. By investing for the long term, you can potentially grow your wealth significantly over time, leaving a lasting legacy for future generations.